Silver surges 22% from $65 low. Is this the bottom or just a fake out? 22% in 24 hours? While you were sleeping, silver exploded from $65 to $78. Bitcoin added $11,000, $1 trillion, flooded back into markets. But here's what they're not telling you. Every time this happened before, 2011, 2016, 2020, the rally lasted exactly 14 days before the floor gave out. So the question isn't whether silver moved. The question is, are you watching a bottom or standing at the edge of the greatest fake out in precious metals history? Welcome to Financial Crisis Explained, where we don't chase headlines, we decode them. Now, before we go any further, if you've lived through a few market cycles, if you remember when silver hit $50 and crashed, if you understand that experience beats excitement, then do yourself a favor, hit that subscribe button, because what we're about to walk through isn't for the crowd chasing quick gains. This is for those who've learned that the market rewards patience, not predictions. And while you're here, drop a comment below. Tell us where you're watching from. Because this story, this movement in silver, it's unfolding differently in New York, London, Shanghai, and your perspective matters. Now, let's find out if this is the bottom or the beginning of something far more dangerous. At 9:47 a.m. Eastern Standard Time on a seemingly ordinary trading day, silver sat at $65 per ounce. Traders were nursing losses. Headlines declared the precious metals rally dead. Forums filled with capitulation posts. The correction that began weeks earlier had finally found its low, or so it appeared. 24 hours later, silver traded at $78, a 22% surge in a single day, in a market that typically moves in fractions. This wasn't a recovery, this was a detonation. To understand the significance of what just occurred, one must first grasp what a 22% move in silver actually represents. In equity markets, such movements trigger circuit breakers. In currency markets, they spark emergency central bank meetings. In commodities, they signal something has fundamentally broken in the supply-demand equation, or the financial system itself. But silver didn't move alone. While silver rocketed from 65 to 78, Bitcoin surged $11,000 in the same 24-hour window, reclaiming $70,000 after days of bloodshed. Ethereum added 18%, clawing back above 2,000 from lows of 1750. Over $340 billion flooded back into cryptocurrency markets in less than a day. The equity markets told the same story. The Nasdaq and S&P 500, which had suffered sharp declines the previous session, fully recovered within 2 hours of market open. The Dow Jones added 950 points, punching through to new all-time highs. The Russell 2000, the index of small-cap stocks that often signals risk appetite, surged 3.1%, adding nearly $100 billion in market capitalization, $1 trillion. Added to U.S. stock markets in 2 hours. This is not normal price action. This is synchronized violence across every major risk asset class simultaneously. The professionals call this a risk-on event, but that clinical term masks the underlying reality. When silver, Bitcoin, small-cap equities, and large-cap indices all surge in perfect unison, it signals one of two possibilities. Either the market has collectively decided the crisis is over, or capital is fleeing something else entirely. The data reveals additional layers of this story. In cryptocurrency markets alone, $550 million in short positions were liquidated. These weren't casual traders. These were leveraged positions, held by those who bet the decline would continue. They were mathematically forced to buy back their positions, accelerating the rally beyond what organic demand would have created. Meanwhile, in Shanghai, silver spot prices hit $82 per ounce, while Western markets traded at $78, a $4 premium. In the physical silver market, such premiums indicate something critical. Buyers willing to pay above global rates to secure actual metal. Not paper contracts, not futures, physical silver. This divergence between paper and physical markets has historically preceded significant dislocations. But perhaps the most telling detail of this 24-hour period wasn't the surge itself, it was the speed. Markets don't typically reverse this violently unless one of three conditions exists. First, the prior decline had gone too far too fast, creating a technical snapback. Second, new fundamental information has entered the system that changes the entire risk calculus. Third, liquidity conditions have shifted so dramatically that asset prices no longer reflect underlying value, but rather the availability of capital itself. The business leaders watching this unfold face an uncomfortable question. If silver can drop to 65 and rocket to 78 in a single rotation, what does that volatility signal about the stability of the broader financial system? When correlations across traditionally uncorrelated assets approach unity, when everything moves together, The diversification assumptions that underpin corporate treasury management begin to fail. This matters because corporate balance sheets, pension funds, and institutional portfolios are built on models that assume certain assets zig when others zag. When everything zigs together, those models break. So the question isn't simply whether silver found its bottom at $65. The question is whether this synchronized surge across silver, crypto, and equities represents genuine recovery, or the violent head fake that precedes something far more destabilizing. Because in 24 hours, the market moved with a ferocity that suggests someone or something knows what's coming next, and they're positioning accordingly. There's an old axiom among institutional traders that retail investors rarely hear. When everything moves together, nothing is safe. The events of the past 24 hours violate a fundamental principle of market structure. Silver is supposed to be a safe haven asset, moving inversely to risk. Bitcoin is supposed to be a speculative technology play, disconnected from traditional commodities. Small-cap equities reflect domestic economic optimism, unrelated to precious metals. Yet all three, plus large-cap indices, surged in mathematical lockstep. This isn't correlation, this is synchronization, and the difference matters enormously. To understand what's actually happening, one must look beyond the price charts and examine the mechanism driving capital flows. The Federal Reserve's balance sheet currently sits at levels that would have been considered catastrophic a decade ago. Interest rates, despite recent adjustments, remain historically accommodative when measured against actual inflation. The dollar index, which typically moves inverse to commodities, has been exhibiting erratic behavior that suggests currency market participants are positioning for something they're not yet discussing publicly. When silver surges 22% while the Dow hits all-time highs, the surface reading suggests optimism. Economic growth drives equity values higher. Industrial demand for silver follows. Everything makes sense until you examine what happened in the 2 hours before U.S. markets opened. Asian trading sessions showed unusual accumulation patterns in physical silver markets. Not futures contracts, not ETFs, physical metal. The Shanghai premium, that $4 gap above Western spot prices, widened during hours when it typically narrows. Someone was willing to pay significantly above global rates to secure delivery of actual silver, not paper claims on silver. This behavior doesn't align with simple optimism about economic growth. Simultaneously, the cryptocurrency markets experienced what analysts are calling forced liquidation cascades. 550 million in short positions didn't close voluntarily. They were mathematically eliminated when prices moved beyond margin requirements. This creates a self-reinforcing cycle. Shorts liquidate, prices spike. More shorts liquidate, prices spike further. The resulting move appears organic, but it's mechanically driven by position unwinding. The equity market recovery followed a similar pattern. The Nasdaq and S&P 500 didn't gradually recover from the previous day's losses. They snapped back in the first 120 minutes of trading. The Russell 2000, which added 100 billion in market cap, did so on volume that suggests algorithmic participation rather than fundamental revaluation. Here's what ties these seemingly disparate movements together. Liquidity. Not economic growth, not corporate earnings, not industrial demand. Liquidity. When central banks inject capital into the financial system, or when credit conditions ease suddenly, that capital doesn't flow rationally into undervalued assets. It flows into whatever can absorb large capital allocations quickly. Silver futures, Bitcoin, index funds, anything with sufficient market depth to handle institutional scale buying. The problem with liquidity-driven rallies is they reverse the moment liquidity conditions change. Consider the timeline more carefully. $1 trillion added to U.S. equity markets in 2 hours. $340 billion added to crypto markets in 20 hours. These aren't valuations changing based on new fundamental information. This is capital rotation at a scale that suggests institutional repositioning, or something forcing that repositioning. The banking sector data from the past week reveals additional context. Several regional banks reported unusual deposit outflows. Not catastrophic, not headline-worthy, but sufficient to raise questions among those monitoring systemic stability. When deposits leave banks, that capital goes somewhere. If it's flowing into silver, Bitcoin, and equities simultaneously, someone is moving away from bank deposits into anything perceived as holding value outside the traditional banking system. This is not how healthy markets behave during periods of genuine economic optimism. There's another possibility that analysts are beginning to whisper about in private communications. What if this synchronized rally isn't about assets becoming more valuable, but about currency becoming less trusted? What if the capital flooding into silver, crypto, and equities simultaneously isn't seeking growth, but seeking exit? The Shanghai premium offers a clue. When physical buyers pay $4 above spot, they're not speculating on price appreciation. They're securing real assets before pricing mechanisms potentially break down. The question business leaders must confront is uncomfortable but necessary. Is this rally evidence that markets have stabilized, or evidence that the smart money is running and running fast? April 28, 2011. Silver touched $49 per ounce. Investors who bought at $48 believed they'd secured the bottom of a brief correction. Within 14 days, silver collapsed to $32, a 35% loss. Those who mistook a relief rally for a reversal watched their positions evaporate. September 2020. Silver rallied 21% in 9 trading sessions after touching a correction low of $23. Technical analysts declared the bottom confirmed. Fund managers rotated capital back into precious metals positions. 17 days later, silver sat at $21. The bottom they'd identified was merely a pause in a descent that hadn't finished. History doesn't repeat, but the architecture of market psychology follows identifiable patterns. The challenge facing current silver investors isn't determining whether the move from $65 to $78 is significant. The move is mathematically undeniable. The challenge is determining whether this significance marks the end of the correction or the intermission before the final act. Professional traders distinguish between 2 types of rallies: reconstitution and capitulation relief. A reconstitution rally occurs when fundamental factors genuinely shift, when the reasons for the prior decline no longer exist, when new capital enters based on changed conditions. A capitulation relief rally occurs when selling pressure temporarily exhausts itself, when short positions cover, when algorithmic triggers fire, creating violent upward movement that has nothing to do with changed fundamentals. The difference determines whether positions established at $78 generate wealth or destroy it. Examining the current rally through this framework reveals uncomfortable parallels to historical fakeouts. The speed of recovery mirrors 2011 and 2020 patterns almost exactly. Both prior false bottoms featured 20% plus rallies within 36 hours. Both showed synchronized movement across multiple asset classes. Both exhibited short covering volume that accelerated price beyond organic demand levels. Both reversed completely within 3 weeks. The technical indicators compound the concern. In genuine bottom formations, price typically consolidates after initial recovery. Assets don't spike 22% and continue vertical. They pause. They retest lower levels. They build what chartists call base support. The current move shows none of this structure. It exhibits the parabolic signature of forced buying, not accumulated conviction. Volume analysis reveals additional warning signals. The surge from 65 to 78 occurred on volume. That suggests derivatives participation rather than physical accumulation. Futures contracts and ETF shares changed hands at rates that dwarf actual metal delivery. This matters because paper markets can reverse instantly when sentiment shifts. Physical markets move differently. The absence of proportional physical buying at these levels suggests the rally is concentrated in instruments that can be unwound as quickly as they were established. Options. Market data tells a parallel story. The put-call ratio for silver options didn't normalize during this rally. It inverted further. Sophisticated market participants are buying protection against downside risk even as prices surge. This isn't the behavior of investors who believe the bottom is confirmed. This is the behavior of traders who recognize they might be participating in a rally, while simultaneously hedging against the possibility they're wrong. Then there's the question of what hasn't changed. The fundamental factors that drove silver's decline to $65 haven't been resolved. Central bank policy hasn't shifted. Industrial demand forecasts haven't been revised upward. Supply constraints haven't suddenly appeared. Mining output remains stable. The macro environment that created the correction still exists. Yet prices have surged 22% as if fundamental conditions transformed overnight. They haven't. What has changed is liquidity. That word again? Short-term capital flows shifted dramatically, but liquidity-driven moves are notoriously unstable. They create price action that looks like fundamental revaluation until liquidity reverses and prices collapse back to levels justified by actual supply and demand. The most disturbing parallel to previous fakeouts is timing. Both 2011 and 2020 false bottoms occurred during periods of broader market instability. Both featured synchronized rallies across multiple asset classes. Both exhibited the exact volatility signature visible in current price action. And both, without exception, reversed violently after brief periods of apparent recovery. The professionals who survived those reversals learned a critical lesson. When markets move too fast, in environments that remain fundamentally unstable, the speed itself becomes the warning. Because real bottoms don't rocket 22% in 24 hours. Real bottoms grind, consolidate, and build slowly. Fakeouts explode. The courtroom of market analysis doesn't traffic in certainty. It weighs evidence. It examines precedent. It renders probability-based verdicts that guide action without guaranteeing outcomes. After examining the evidence presented across 3 analytical frameworks, the data supports not one conclusion, but 2 competing scenarios of nearly equal probability. This ambiguity isn't a failure of analysis. It's an acknowledgement of reality. Markets exist in superposition until events force resolution. The case for a genuine bottom rests on several compelling data points. First, the Shanghai premium persists. Physical buyers continue paying $82 when Western paper markets offer $78. This $4 spread has widened, not narrowed, since the rally began. Historical analysis shows sustained physical premiums often precede extended price advances because they signal real demand outpacing available supply. Paper markets can be manipulated. Physical delivery cannot be faked indefinitely. Second, the synchronized rally across silver, Bitcoin, and equities suggests institutional capital rotation of significant scale. Individual retail traders don't move $1 trillion in 2 hours. This represents coordinated repositioning by entities with access to information beyond public headlines. If major institutions are moving into risk assets simultaneously, they may be pricing in scenarios the broader market hasn't yet recognized. Third, technical support levels held precisely where historical patterns suggested they would. The $65 low touched a Fibonacci retracement level that has marked previous cycle bottoms. Price respected this zone and reversed with conviction. This suggests algorithmic and institutional buying programs activated at predetermined levels, providing a foundation for further advances. The bull case has structural integrity, but so does its opposite. The case for an elaborate fakeout carries equal evidentiary weight. The speed of recovery violates every principle of sustainable bottom formation. Markets that reverse 22% in 24 hours are exhibiting liquidity-driven violence, not fundamental revaluation. The 2011 and 2020 precedents showed identical technical signatures. Both led to deeper lows within weeks. The current move mirrors those patterns with unsettling precision. Volume composition raises critical questions. Futures and derivatives volume massively exceeded physical transaction volume during this rally, 550 million. Enforced short liquidations artificially accelerated price beyond organic demand levels. When mechanically driven buying exhausts, when shorts finish covering, the bid support beneath current prices may prove dangerously thin. Most significantly, nothing fundamental changed. The macro conditions that drove silver to $65 remain unresolved. Central bank policy hasn't pivoted. Industrial demand hasn't surged. Mining supply hasn't constricted. Currency instability hasn't been addressed. Markets are pricing in recovery, while the underlying conditions that caused the correction still exist in full force. The options market reveals what institutional money actually believes. Despite price surging to 78, put option volume remains elevated. Smart money is hedging downside even while participating in upside. This is not the positioning of investors convinced the bottom is secure. This is the positioning of traders managing both scenarios simultaneously. So what should corporate treasurers, fund managers, and business decision makers actually do with this information? The answer lies not in choosing which scenario is correct, but in positioning for both. For those holding silver positions established below $65, this rally offers an opportunity to reduce exposure while maintaining strategic allocation. Taking partial profits at 78 while keeping core positions allows participation in further upside while protecting against reversal risk. For those considering new positions, the prudent approach involves staged entry rather than concentrated commitment. Allocating capital in thirds at current levels, on pullbacks to 72, and on either a breakout above 85 or a decline below 68 ensures participation regardless of which scenario materializes. The critical monitoring points for the next 30 days are clear. If silver consolidates between 75 and 80 for 2 weeks without collapsing, the bottom thesis gains credibility. If physical premiums in Shanghai expand beyond $5, actual supply constraints are emerging. If silver breaks decisively above 85 on sustained volume, the technical case for continuation strengthens materially. Conversely, if price fails to hold 72, if volume diminishes on rallies and expands on declines, if the Shanghai premium contracts, the fakeout scenario is likely unfolding. The markets don't reward those who guess correctly. They reward those who prepare comprehensively. This isn't a bottom or a fakeout. It's both possibilities, existing simultaneously, until reality collapses the waveform. Position accordingly.